Bonds are pretty boring. And that's a good thing.
Bonds are usually seen as a very safe and stable investment, but you're also not going to make huge earnings off of bonds. For governments, this helps raise funds for things like infrastructure, schools, hospitals, those kinds of things.
Bonds have a price and a yield which move in opposite directions. If interest rates go up, prices go down. So higher yields make lower prices, but they're important because it gives a gauge of how much it's costing our government to borrow money.
But recent concerns over how much money governments are borrowing has turned the bond market into a bubbling cauldron of uncertainty.
We now have a trade war. We also have Trump's tax cut bill.
We stand ready to continue our work together to deliver on the one big beautiful bill, as President Trump named it himself.
The Congressional Budget Office projects this bill would create more debt.
And we're going to incur another $22 trillion deficits over the next 10 years, and that's probably a rosy scenario.
The bond market, and particularly U.S. Treasuries, which were seen as a haven for so long, are no longer as safe.
Government bonds sold off dramatically.
Long bonds, those that mature in 30 years or more, have been at the center of these concerns.
Hello, folks.
United States savings bonds are the most widely held securities in the world.
Their shares in America.
United States savings, stamps, and bonds.
Buying bonds builds security for yourself as well as your country, and that's not a bad combination.
Normally, the longer you lend money to the government, the more interest you earn, as the risks are greater, so the yield curve usually slopes upward. This year, given the degree of investors' concern over the fiscal outlook, 30-year yields were rising at times that rates on shorter maturities were actually falling.
We've seen a lot of volatility, so people are somewhat scratching their head. What's going on with the bond market? Because I thought that was the boring, safe, simple thing.
Yields on long bonds spiked above 5%, nearing the highest since 2007.
Those long-end yields have risen some 50 basis points just from Monday alone. This is really maybe the beginning signs of financial stress in the market.
The risk now is interest rates are going to be structurally higher, and therefore issuing long bonds no longer makes sense financially.
There was a time when long bonds were very popular.
We had this period before the pandemic, before inflation spiked, where investors were very desperate for assets that had a decent yield. Because most bonds in Europe and Japan, for example, were often near zero interests or negative yielding. So they demanded longer maturity debts, going out 50, 100 years.
There's a few countries over the last 5 years or so that have sold 100-year bonds, like Austria and Ireland.
The governments that issued these types of bonds, it was perfect. It meant they could lock in historically low financing costs for 100 years. And investors liked it too, because they got more yield than buying a shorter maturity bond.
These countries were saying, wow, if we can sell some of our debt and lock it in at this low rate for 100 years, we're kind of buffering our interest costs. Central banks were just flooding the system after the pandemic with liquidity and buying bonds to help nations and economies do better. So countries and companies were selling long-term debt.
But there was a little problem with the long bond frenzy.
It was all hinged on this bet that inflation would remain low. So when, in 2021, 2022, inflation spiked, the price of these bonds fell dramatically and the yields went up.
It just seemed like such a hot thing when rates were near zero, and it hasn't really panned out, because when rates go up, they're a real problem.
The easiest way to see the demise of long bonds is to look at the very longest of bonds. In Europe, that's Austria's century bond, which is debt maturing in 2120. Price has fallen about 75% from its peak in 2021. That's the sort of move that you don't really associate with government bond markets. It's the sort of move you associate with meme stocks or crypto. It's that completely flatlining of long bonds price which shows that investor demand for such assets has disappeared.
High interest rates are only part of the problem. Faith in government is also part of the stew.
The money moving around in the investments, this is stocks, bonds, corporate governments, derivatives, credit, you name it, 30 trillion. You are going to see a crack in the bond market.
We've had this kind of globally some concern about fiscal spending, and so interest rates, long-term rates, have gone up, and that's been a concern about if there's all this deficit spending, we need to be compensated for all this risk. We want higher yields.
Elon Musk is telling Americans to kill the bill.
It's really hard for investors to know what's going to happen in 100 years or more, especially with governments and economies that are spending and changing their policies constantly.
And U.S. trade policy is acting as another straw on the camel's back.
There's a lot of uncertainty about Trump's tariffs policy. That's adding to concern and volatility and driving yields higher as well.
On one hand, he's announced a series of tariffs on the global economy, which might fan inflation, and that's bad for bonds and should increase yields. On the other hand, it should slow down economic growth, which might lead central banks to cut interest rates, and bonds might follow by reducing yields in tandem.
Well, I thought that people were jumping a little bit out of line. They were getting yippy, you know? They were getting a little bit yippy, a little bit afraid.
The chaos and uncertainty Trump has injected into the normally rock-solid U.S. bond market is having knock-on effects around the world.
Across the board. It's this kind of global movement of rates higher which has been really interesting in the last few years.
When it comes to long bonds, Japan might be the canary in the coal mine.
What we've seen in Japan is completely unprecedented because Japan has long been a country with ultra-low interest rates. As the Bank of Japan pulls back, who is going to buy Japanese government bonds in Japan? The immediate answer would be major life insurers or other Japanese institutions, but they have been really cautious about buying those longer-term bonds because of the volatility from Trump's trade war. So you've seen Japanese government bonds actually spill over into other markets, including US Treasuries, Australian bonds, and this is very unique because usually Japanese government bonds don't impact other markets like that.
Countries like the United Kingdom and Japan, they may decide to shuffle their debt mix to have more short-term debt, to lean a little bit away from long-term debt.
So volatility in long-term bonds is a problem for the government because investors are going to demand higher yields. They have to keep borrowing.
Eventually, these higher yields will affect kitchen tables the world over.
For the day-to-day people's lives, that affects things like housing affordability for mortgage loans. It impacts auto loans, student loans, credit card rates.
With central banks seemingly content to hold steady on interest rates, some stability has returned.
Our bond issuance is going quite well. We are actually seeing an uptick in primary purchasers.
There was also some hope in an auction of 30-year treasuries avoiding an all-out buyer strike in long-term bonds. But these reassurances might not be enough to convince investors that long bonds are a risk still worth taking.
There is still this lingering fear in the back of investors' minds that inflation might not be entirely under control.
The sell-off in longer-term bonds really shows investors that all of these major governments have a huge fiscal deficit problem and that it's really a ticking time bomb because that's not going to be solved anytime soon. So we're going to continue to see higher longer-term yields and it's going to have ramifications across global bond markets.